and welcome to Value Research Helpline. I'm Ruchira and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining us is Ashutosh Gupta, Vice President, Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Now, today's first question has been sent in by Arnab Bhattacharjee, who wants to know how the same fund can have a different rating for its regular plan and direct plan.
Okay. Well, as we've often mentioned, the rating of a fund is a quantitative measure based on the relative risk-adjusted performance of a fund in relation to its peers, the funds in the same category. Now, the important thing to note here is that the direct plans of a fund are compared only with the direct plans of other funds, and likewise, the regular plan of a fund is compared only with the regular plans of the funds in the same category. Now, the question is, what could lead to a different risk-adjusted ranking for the direct plan versus the regular plan of a fund? Well, the simple answer to that is its expense ratio. It is not rare to come across funds which rank fairly low or below average in relation to their peers in terms of the expense ratio of the regular plan. But when we move over to the direct plan, they might appear fairly high in terms of their expense ratio. Now, once that happens, of course, that also eats away into the returns of the regular or the direct plans and impacts their relative ranking in terms of the performance. And that in turn affects the rating of these two plans. And that's why we've been saying that expense ratio is an important consideration for you while choosing a fund, even more so in case of a debt fund.
The next query comes in from Ashutosh Maru, who says, all HDFC mutual funds are not doing great, especially the HDFC Hybrid Equity as compared to other funds in the category. So he wants your advice on this.
Well, HDFC Hybrid Equity was formed with the merger of the erstwhile HDFC Balanced Fund and the HDFC Premier Multi-Cap Fund in 2018. This was done after the SEBI's reclassification and categorization of mutual funds exercise. Now, the portfolio of this fund is fairly conservatively managed, I would say. The equity component of this fund is largely invested in large caps. It's a large cap heavy portfolio. While on the debt side as well, the fund manager likes to invest predominantly in bonds of top rated corporate issuers. The fund does invest a little bit of its portfolio in lower than top rated papers, but the fund manager well mitigates the risks by keeping the portfolio very well diversified. Now, when it comes to the performance of this fund, ever since the merger took place in 2018, the performance hasn't been great, but at the same time, it has not been an outright poor performer either. So, well, of course, you can find more compelling options in the category of aggressive hybrid funds, but this fund also does not rank among the bottom performers. So, all in all, I would say that it would be worthwhile to wait and watch this fund. And if you already have investments, it's not a bad idea to continue to hold on to them.
Now, Roshan Kumar asks, how important is it to invest in a small cap fund for wealth creation?
Well, it's not at all compulsory to invest in a small cap fund. Well, small cap segment of the market generally tends to be more rewarding over the long term, but stocks in this segment are also riskier and more volatile. Typically, they have a higher mortality rate. These companies also find it harder to survive through the economic shocks of the kind that we witnessed during the pandemic times. There can also be other issues like corporate governance issues, which could be hard to detect or unearth. So it is basically a high risk, high reward strategy meant to play a supplementary role in an investor's portfolio. Typically, one should look to allocate not more than 10-15% of their overall corpus to small cap funds, and that too if they are okay to withstand severe ups and downs in their portfolio value. Otherwise, one can easily do without small cap funds. Remember, even the multi-cap funds typically allocate some portion of their money to small caps. So even if you are investing in multi-cap funds, you tend to get a reasonable small cap exposure in your portfolio. Now, if you do decide to take some measured exposure to small caps, it's desirable and preferable to do so through mutual funds rather than directly in stock markets, because this segment of the market requires a far deeper level of research and continuous monitoring, which may be difficult for an individual retail investor to do on their own.
All right. NM Rajagopal Sridhar wants to know, should ESG funds form part of the equity portfolio? How are they different from multi-cap or large cap funds?
Well, let me talk a bit about ESG, which is a theme which is fast gaining traction. ESG stands for environmental, societal, and corporate governance factors. Now, it is widely understood and acknowledged that companies which score high on these parameters tend to outperform the broader markets. They tend to have lower cost of capital, they tend to have better operational efficiency, and there are less chances of a regulatory or a societal backlash. Now, all these factors reflect favorably in their stock price appreciation. I don't have very precise numbers on this, but globally, it is a widely accepted and a widely acknowledged investment theme already. There are thousands of funds focused on ESG theme, managing several $trillion of money. Even in India, this theme is gaining momentum. There are several AMCs which have already launched an ESG fund or are in the process of doing so. Now, coming to how do these funds compare with multi-caps, I would say that the latter have a broader investment mandate and a broader universe of stocks to build their portfolio from, while ESG would essentially be a subset of the stock universe that a multi-cap fund would have, limited to only those stocks which score high or meet the threshold criteria on ESG parameters. Now, we did a preliminary study based on the 4-5 ESG funds whose portfolios are available at the moment. And our preliminary findings suggest that about 20 to 30% of the portfolios of multi-cap funds are invested already in stocks which would be eligible, which score high on the ESG criteria. So remember, through your multi-cap funds, you're already getting a fair bit of an ESG flavor in your portfolios. So I would suggest that it may not be a bad idea for now to wait and watch how the ESG theme evolves in the Indian context, and till that time continue to focus more on the multi-cap category of funds. And really, this is not any different from what we otherwise recommend on any new fund.
Vineet Sahu says, seeing mutual fund investments erode to 60% of the principal amount during March-April 2020, it is reassuring to see the investments climb back to a respectable 8% annual return. So should I cash out and reinvest later?
No, I would not recommend that to him. See, trying to time your entry and exit into the market to generate returns is a futile exercise. Just like he could not preempt the market fall in the month of March and therefore safeguard himself from the losses, similarly, if he decides to exit from the market now, it will be very difficult to decide on when is the right time to re-enter the markets. If the markets continue on their momentum and continue to reach new highs from here on, he would keep sitting on the sidelines and lose out on the potential gains. But on the flip side, if the markets correct from here, he would still be unsure of whether the markets have bottomed out and therefore it is the right time to enter the markets, or whether there is more fall to come. So the broad point is that timing your entry and exit into the market does not really work on a sustainable basis. Look at the fund managers. Even the most seasoned of fund managers rely on their stock selection and the time that they spend in the market to generate alpha rather than deft entry and exits into the market. There are hardly any fund managers who take active cash calls, and most of them prefer to remain fully invested. So I would not recommend a timing the market kind of a strategy to this gentleman. The only sustainable way to make money in the markets is to remain invested through the ups and downs of the market. In fact, invest through the ups and downs of the market. So I'd say that if he needs his money in, let's say, about a year's time, then he should not be in the market at all. But if he does not need this money for the next 5 years or more, then by all means he can stay invested.
All right, Vipin Thapar wants to know, when one switches from one fund to another of the same fund house, it is not considered as redemption. So are there any tax implications?
Well, I'd say that his understanding is incorrect on this point. When one redeems from one fund and invests that money in another fund of the same fund house, there is a redemption and a purchase transactions. Those are recorded. And the redemption leg of this entire activity attracts exit load applicability and capital gains tax. Not only that, if an investor were to redeem from, say, the regular plan of a fund and invest in the direct plan of the same fund, even that attracts exit loads and capital gains tax. So he should be mindful of these considerations while rejigging his portfolio.
Anup Mitna has invested in Bharat 22 ETF and CPSE funds. He wants to know if we should stay invested. Also, he suggests that PR premium service should include ETFs as well, since these are a substitute of mutual funds.
Well, to answer his first question first, the Bharat 22 ETF and the CPSE ETF, well, the performance of these funds have been disappointing, and that's really a reflection of the performance of the market segment where these funds invest. If we look at their performance this year since the start, the Sensex is up by around 10% up till this stage, while the PSU index is down 18%. That's a massive underperformance. Even the longer term record of these funds is very disappointing. So there is a compelling case to look for better alternatives over there. Now, coming to his second question, in the premium account, we do provide coverage to ETFs. In fact, we have some ETFs as part of our analyst choice list of recommended funds. And even more broadly, we do provide our analyst opinion in terms of buy, sell, hold on the ETFs. So I'd suggest if he's unable to find this coverage, he can get in touch with our customer support team and they'll be happy to help him.
The next query comes in from Nishan, who's planning to invest in Nasdaq 100 ETF. He's asking for suggestions on whether he should opt for the ETF variant or the FOF variant. He has a demat account, he says. So which one is better with respect to liquidity, return, and safety?
Well, I'd say that both the ETF and the FOF variants of this fund are investment worthy. Typically, mutual fund investors prefer the FOF route because it saves them from the hassle of opening a trading account and a demat account. But since this gentleman already has a demat account, so he can very well go ahead and invest in the ETF. In fact, that will save him from the additional expenses of a fund of fund. Now, coming to his second question, regarding returns, I would say that barring the difference, a slight difference in the expense ratio of the two variants, both would be pretty similar in terms of returns because the underlying portfolio of both of them is same. Now, as far as safety is concerned, well, these are equity investments and he should bear in mind that there are no guarantees on offer of any kind. These investments can be fairly volatile through the ups and downs of the market. But hopefully they should be rewarding over a long-term time frame. Now, coming to the liquidity bit, there is no concern in case of the FOF variant really, because the AMC stands committed to honor the redemptions at the applicable NAV on any given working day. But even on the ETF variant of this fund, there are really no big concerns on the liquidity front. Because I understand that this variant, the ETF of this fund, is able to generate sufficient liquidity, sufficient trading volumes on the stock exchange on a day-to-day basis. So for a retail investor, there should really be no concerns in buying and selling the units of the ETF. So he can very well go ahead with it.
Seth Maulan Bihari Lal asks, should we invest in multiple funds managed by same fund manager in different categories?
Well, the principles of diversification suggest that one should be diversified at the AMC level as well. And this holds true even if we are talking about two funds which are very different in their investment mandate and therefore maintain a very different underlying portfolio. That's because despite a difference in the investment mandate, they have a common underlying research team. And there would be some certain commonalities that would reflect in their portfolios, which could relate to the research team's view on the state of the markets, their outlook on different sectors, their approach to stock selection, their investment style. So these are all the common threads that would run through the funds of a particular AMC. And these commonalities would be even more pronounced if they are managed by the same fund manager. So I would say that it would be wise not to commit more than say 30-40% of your money to the funds of the same fund house, and beyond that look to diversify across the AMC level.
Amol Patel wants to know if we can invest more than 2 lakh rupees in NPS. Is there any maximum limit like PPF?
Well, there is no upper limit on investing in NPS really in any financial year. But bear in mind that the tax benefits would accrue to him only up to a maximum limit of rupees 2 lakh. So 1.5 lakh out of this are available under section 80C of the income tax, while another 50,000 of extra benefit is available only for NPS under section 80CCD. The minimum limit of investing in any financial year in NPS is rupees 1,000. And as he rightly pointed out, that the upper limit in case of PPF in any financial year is rupees 1.5 lakh, while the minimum limit in case of PPF in any financial year is rupees 500.
All right, now Sanjeev Deshpande is a premium account holder. He says, you have suggested me to sell a fund. So should I sell it ignoring tax implications and invest in a better fund of same category at one go? Or should I go from SWP from source fund and SIP in destination fund?
Well, I would say that no, he should not ignore the tax implications. Those are important implications and can make a meaningful difference to one's returns. So I would suggest that if waiting for a few months saves him from exit load or tax implications, then it would be worthwhile to wait out. And these details about the exit load applicability and the tax implications he can also get from his premium membership account. Now, with regard to his second leg of the question about how he should go about doing it, well, I'd say that since this money is already invested in the markets right now, there is no need to spread this reinvestment systematically over a number of months. He can very well do it at one go, but I would rather suggest him to do it in 2 to 3 tranches. So immediately he can look to exit and reinvest the portion of his money which is free of loads and taxes, and then wait out for a few months, and for the balance amount do so once that portion is load and tax free.
Bala K says, due to loss in equity funds in COVID period, I switched to banking PSU debt and short-term bond funds. Government low interest rate may prevail up to March 2021. So do you expect interest rate to go up after that? And if so, which type of fund I can switch to get reasonable returns without loss?
Well, I'd say that it's very difficult to predict the trajectory as well as the direction of interest rates with precision. If you look at the current state of the things, there are forces and counter forces. So on one side, the RBI has clearly communicated its preference for a continued accommodative stance, which it wants to carry well into the next financial year. But on the flip side, inflation has been at an elevated level. They've remained at a higher levels, and it's been quite sticky. Also, the economic growth has been better than expected. So there are lots of factors at play here, and it would be very difficult for anybody to predict interest rates with any degree of precision. And that really brings me to the broader point that while making your investment decisions or your asset allocation decisions, one should be far more focused on factors which are in one's own control, rather than basing these decisions too much on the macroeconomic factors. So he should really be focusing far more on factors like his goals, his time horizon, his risk appetite, and those would throw up more definitive answers about where he should be investing and what should be his asset allocation. And that's really how he should go about it.
Arkaprova Saha has to invest 50 lakh rupees in debt funds for 2 to 3 years. So how many debt funds are suitable for this, he asks. Also, should he choose debt funds from different AMC? What type of debt funds will be preferable for this?
Well, I'd suggest that this person can choose 3 to 4 high quality short duration funds. And yes, it's highly desirable and highly recommended to spread and diversify across AMCs, so that any adverse and any fund specific or AMC specific events that have a negative implication do not put a substantial portion of this person's capital at the risk of loss. So it's highly desirable to spread the money across a few AMCs.
Now, Renu's investments have gone up by 40% because she invested when the markets crashed in March. So should she book the profit by selling the investment or not?
Well, first of all, congratulations for making some handsome gains in a short span of time. But she should really consider this as a windfall. And I believe that she simply got lucky that the markets staged a swift recovery immediately after she invested. The important point to note is that she should not get carried away with this initial success and start believing in the importance of timing the market to make money from the markets. The only sustainable way to make money in equity markets is to follow a disciplined and a systematic approach and invest through the ups and downs of the market. So regarding these current investments, I would say that if she doesn't need this money for the next 5 to 7 years or more, she can very well stay invested. But having said that, if the potential risk of losing out on some of these gains, if the markets were to crash from here on, if that makes her too anxious or too nervous, then it may not be a bad idea for her to shift, say, 20 to 25% of her money into fixed income alternatives and maintain that kind of an asset allocation in a steady state.
All right, today's last question comes in from SK Sharma, who asks, which is a better strategy, buy and hold or doing asset allocation?
Well, I'd say that these two are very different concepts and not necessarily at odds with each other. Ideally, one should follow both. So talking about buy and hold first, it's simply a method where an investor takes a much longer term outlook while making investing decisions. So taking an example of a stock investor, somebody who is a follower of a buy and hold approach would typically look at his stock selection from a longer term time frame, maybe 3 to 5 years or even more, and typically hold on to his stock investments till the time some adverse events happen which compel him to exit out of these investments. He would not be guided by the day-to-day movements of a stock price and really shift frequently and swiftly from his investments. Now, in contrast to that, the asset allocation simply means investing or deciding on a mix of different asset classes, commonly debt and equity, a mix which is suitable to one's investment needs, and then investing in that mix, and then periodically rebalancing one's investments to stay in a narrow range around that predefined mix of different asset classes. I'll take an example to explain that. Let's say you invest in equity and debt in the proportion of 75 to 25 for an investment goal. Now, one year down the line, let's say the equity markets run up substantially and the equity allocation rises to become 82% of one's allocation. So it would call for a rebalancing to restore the 75-25 asset allocation that this person originally started with. Now, even a buy and hold investor would need to do this rebalancing by selling a part of his equity investment and buying debt from it, even if there is nothing fundamentally wrong with his equity investments. So this way, these two concepts can work complementary to each other and they are not at odds with each other. Ideally, both of them should coexist.
Well, that's it from us. Thank you, Ashutosh.
Thank you.
Thank you to all our viewers. You can go to VR Helpline on Value Research Online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Bye for now.